Hello everyone, it's nice to see you again in this meeting. Well, today we are going to talking about analyzing operating activities, and here my group will present it for all of you guys. In this group itself, there is me, Monica M. Damanik, Alfa Kevin, Baik Putra, and Abigail as well. Well, let us see the outline that we are going to decipher in this meetings. Well, the first we are going to talk about income measurement, and we'll be continue to the non-recurring items, and then after that we are moving on to the revenue recognition, and then deferred charge, and the fifth one is supplementary employee benefits, and the last we have to discuss about interest costs and income taxes. We continue to the next slide. Well, we have to know about the income measurement firstly before we are going talking deeper about this topic. First, we have to understand about the concept of income itself. So actually here we have two concepts of income. The first is economic income and permanent income. Let's see what's on the economic income. So in this economic income, the equal net cash flow just added by the change in present value of future cash flow, and then in this economic income it also includes both recurring and non-recurring components. And what's on the permanent income, it is also called as a sustainable earning power or sustainable or normalized earning. And here in this permanent income, it is estimate of stable average income that a company is expected to earn over its life. So actually there are a lot of things about permanent income, like it actually reflects a long-term focus and also can directly proportional to company value and so on. But let us move to the next slide. We have to know about the thing that we have in accounting income, and there are about three components. The first is the permanent component. Well, in this permanent component, the recurring component expected to persist indefinitely, and then for the transitory component itself, the transitory component not expected to persist. It means that the concept of economic income includes both permanent and transitory components, and the last one is the value irrelevant component. In this component, the value irrelevant have no economic content and they are accounting distortion. So that's for the component that we have in the accounting income. Then we move to the fifth slide. Here we also have to know about two main components in accounting income. So the first, there is revenue or gains, and the other components is the expenses or losses. But let us see here what is the difference between revenues and gains. So let us just focus to the bold one. It is said that revenues basically the total amount of income generated by the sale of goods or services related to the company's primary operation. Otherwise, gains itself is indicate the net money made from other activities like the sale of long-term assets. I think if we just only focus for the bold part, it's already easy for us to understand and take the main difference between those words. And if you want to know more about this, you can read the whole of this slide and also read our paper that we already sent to you. And then we move to the next slide. Yes, this is about the expenses and losses. So actually these two words also has a difference. Let us see. Expenses are always recorded as debit entries in expense account. Meanwhile, losses itself will also be recorded if a company is ordered by a judge to settle a lawsuit, or if it loses money on the financial investment. So basically the difference is just about how we record it. And the last part on this, on these subtopics on income measurement, we have also to know how to differentiate the operating income and the non-operating income. And here the main difference that we can see between these two things is the first, operating income is measure of company income as generated from operating activities. And the important aspect of operating income, it's just like the pertains only to income generated from operation. The focus is on income for the company, not simply for equity holders. It means that financing, revenues, and expenses are excluded. And the third one is pertains only to ongoing business activities. Just for instance, result from discontinued operation is excluded. And the next is we have to see the non-operating income itself. So here it includes all components of net income excluded from operating income, useful to separate non-operating components pertaining to financing and investing. So that's all about the income measurement. The next part gonna be explained by my friends. Thank you.
Okay, hello everyone, and today, right now, we are going to continue the discussions about revenue recognition. So revenue recognition is very important when it comes to financial statement making in the process of making a financial statement. So when do we recognize revenue? We recognize revenue when earning activities are substantially complete and no significant added effort is necessary, and risks of ownership is effectively passed to the buyer. So from these 2 points, we can say that we can recognize revenue when we have completed our service of our products and when the buyers has effectively owned our service or our product. And revenue is recognized normally in yields of an increase in cash or receivables. So there is some special case for revenue recognitions, and it is about revenues when right or return exists. So when you are, especially when you are making a product and you're creating some guarantee or some return when there is a product that is misaligned or a byproducts. Therefore, you create a return, a guarantee in order to gain the trust of the customers. And then we have a revenue under contracts. It is about percentage of completion method and completed contract method. I believe we have discussed it before in the previous class and the previous semester. And then it comes to unearned revenue. It is the amount of revenues that are still unrecognized appear in the balance sheet as a liability. So when the customers paid in advance for our revenue, but we haven't yet complete our service, therefore it is recognized as a liability named unearned revenue. Like I said here before in the first point, earning activities are substantially complete and no significant added effort is necessary. Yet in this case here, we haven't completed our service, but we already received the revenue to receive the cash. Therefore, it is a liability for us to complete the service to the customer who paid first. Now we are going to talk about deferred expense. It is cost incurred but deferred because they are expected to benefit future periods. Now there is 3 categories of deferred costs. It is research and development or R&D, cost in extractive industries, and miscellaneous, many others. So when it comes to an expense, when we purchase something or pay something, we expect something in return, right? But this kind of expense is something that we need to expend, we need to pay, but we haven't quite sure or the income, or the profitability or something that we paid before is clear to see the income for it. We'll talk about it now. And deferred expense, one of the example is research and development. Accounting for R&D is problematic since it is quite uncertain for any potential benefits. Like I said before, when we are trying to pay something, we are trying to make some advantage or gain something from that expense, but R&D is quite uncertain for any potential benefit since we are trying to get some information, and information is quite hard to be tangible. It is quite intangible. And the time period between R&D activities and determination of success. So R&D activities are quite hard to determine when will it be completed. Therefore, it is hard for R&D to be checked for its expense. And then the intangible, as I said before, intangible nature of most R&D activities, and then difficulty in estimating future benefits period. And then we come to the extractive industries like oil and mining industries. Search and development costs for natural resources is important to an extractive industries, including oil, gas, metal, coal, and non-metallic minerals. And there is 2 accounting view when it comes to extractive industries. The first one is full cost view, and then the second one is successful effort view. The full cost view, when all costs, productive and non-productive, is incurred in the search of resources, are capitalized and amortized to income as resources are produced and sold. While on the other hand, successful effort is all costs that do not result directly in discovery of resources, have no future benefit, and should be expensed as incurred. It is mainly prescribed for oil and gas producing companies. And why do we need to look at these two views? So successful effort. A successful effort is a method is more to a conservative approach to oil and gas accounting, since its mandate in immediate charges to expense when a dry hole is drilled. So when you are running a mining industries or an oil industries and you try to drill a hole to mine an oil within some certain places and it turns out there is no oil in it, therefore we in a successful effort we try to charge it immediately to an expense. By doing so, expense recognition is accelerated, leaving the smallest amount of expenditures recorded as an asset of the balance sheet. And then when it comes to full costing, the advantage of full costing include compliance with reporting rules and greater transparency. So if you are running an oil company and you are using full costing, you can simply brag about it and tells to the financial statement that you are using full costing in order to comply with reporting rules and greater transparency. While the drawbacks include potential skewed profitability in financial statement and difficulties determining variation in cost at different production levels. And that is about deferred costs in oil and mining industries.
Okay, everyone. The next topic relate to about supplementary employment benefits. So I will explain and discuss what kinds of relate to sub plans from the definitions and how does it works. What are types of sub plan self? How we will apply how will to apply it, and some pros and cons relate to sub plan. Okay. The first one, of course, we need to know but what is the definition of sub plan. So as we can see at the slide, so the supplementary employment benefit, can we call sub-plan, are the tax benefit payout to terminated employees due to training, illness, or injury, reduction in force, or temporary layoff. So this benefit are a supplemental income to state employment benefits and are exempt for payroll taxes. So how does a sub-plan works? When a company is downside, it can be costly for the employees to pay out a lump sum to land of employees. Therefore, the sub-plans allows them to contribute to the fund over time, and also it can minimize the financial impact of the company. The sub-plan is also can reduce payroll tax liability for the employers and also for employees, because the sub pay self is classified as benefits, not wage. In other words, this fund are exempt for payroll taxes like FICA, FUTA, or SUTA, and offered in lieu of traditional severance pay. Okay, so here are types of sub plan. divided by two types. The first one is the common type, divided again by two types. The first one is extended layout benefits. It provides during temporary layout like reduction in the number of workers as a costing threshold. And the second one is full role benefit. It provides when employees are made to work for lesser hours due to a reduction in force payments, which are no wages are provided as part of sub-plan self. And the second type is the fund type, which also divided by two kinds. The first one is collective fund, where employees collectively contribute to a common fund which is then used in this type of situation. And the second one is individual fund, where employees contribute to individual accounts from which that employee will take the benefits from it anytime. Okay. Now as we can see how the employees can apply for sub-plan. So to receive sub pay from the company, former employees especially must and also for employers active must be eligible for state employment benefits and willing participant of their employees sub-plan. So to get the sub pay, so the employees in the company must join the sub-plan self. They are also required to file a claim with the employment insurance office in the state where they work. So they need to make a claim form about their employment condition, insurance office in the state wherever they are working. Of course, the sub-plan rules maybe could be different depend for each companies depending on state you are in. And the last one is what is pros and cons of sub-plan. As you can see at this slide, the sub-plan has so many pros and cons. So the pros are the sub-plans can avoid payment of lump sums. The second one, as we know before, the sub-plans of course can eliminate any payroll taxes for the employee. And the next one, the sub-plans can save a lot of costs for the employee. And the next one, the sub-plans can allow the company for better cash flow management. And the last one, assist employees to maintain an income well. The sub-plans as usually for the assist employees to maintain an income while they are out of work. And also there are some cons of the sub-plans. The first one is about to designing the plan itself. It will be need so many detailed financial accounting, financial company analysis. Yeah, just make sure they don't to make sure they have the budget. The company have the budget to make the plan. The second one, as we know before, the participant, which are the employees in that company, have or even must to prove that they are entitled to state unemployment benefits. So if they can prove that can prove that they are on unemployment benefit, they can receive the sub pay. And the last one, maybe the admin can be time consuming, especially administration costs, I guess. Okay, I think that's all from me. And the next one will be presented by Abigail. For Abigail, time is yours.
I will continue the presentation, and the first one I will talk about interest cost. The definition of interest is it is a compensation for use of money or excess cash paid beyond the money or that is borrowed or loaned. Interest is determined by several factors, and one of the most important is credit or non-payment risk of the borrower. And interest expense is usually determined by interest rate, principal, and time. Capitalization of interest is required as part of the cost of assets constructed or otherwise produced for a company's own use. The purpose of this capitalization is to measure more accurately the acquisition cost of an asset, and the second one is to amortize acquisition costs against revenues generated by an asset. Next, we will analyze about interest. The first one, we found that interest or convertible debt is controversial by ignoring the cost of conversion privilege. Many contend that ignoring the value of a conversion privilege and using the coupon rate as the measure of interest ignores the real interest cost. Somewhat, it contrary to this position. Computation of diluted earnings per share use the number of shares issuable in the event of conversion of convertible debt. This in effect creates an additional charge to the coupon rate through diluting earnings per share. Accounting for interest capitalization is also disputable. Some analysts take the position that interest represents a period cost and is not capitalizable. Whatever one's views, our analysis must realize that accounting for interest capitalization is vague, leading to variations in practice. We must remember that capitalized interest is included in assets cost and enters expense via depreciation and amortization. And the last one, we found that change in a company borrowing rate not explained by market trends and reveal change in risk. Next, we'll talk about income taxes. Income tax expense is a substantial cost of business. Understanding the accounting for income taxes is important to successful analysis of financial statement. The discussion here focuses on the accounting and analysis of periodic income tax expense and associated assets and liabilities and not on tax law. So, we found that taxable income is not the same like financial statement income. The complexity in accounting for income taxes arise because the rules for determining taxable income are based on the prevailing tax laws, and these rules are different from the rules for determining reported income under GAAP, which forms the basis for the financial statement. In general, tax rules are closer to cash-basis accounting, permitting fewer accrual than allowed under GAAP. Also, rules for calculating certain accruals, such as depreciation, are different under tax laws than under GAAP. Additionally, tax laws allow exemptions or deductions for certain items that have no real economic basis. And finally, tax authorities do not provide refunds for net operating losses. Rather, these losses are carried forward and offset with income arising in future periods. For these reasons, income reported in the financial statements can differ substantially from taxable income. Companies therefore maintain two sets of accounting books, one for financial reporting and one for tax accounting. So, the differences between tax and GAAP income or financial statement income are essentially of two types. They are temporary and permanent. Temporary differences, as the name suggests, are differences that are temporary in nature and are expected to reverse in the future. Such discrepancies are mainly in the nature of timing differences between tax and GAAP accounting. Meanwhile, the permanent, just like its name, it means it's a permanent differences. So here is a table about the differences between the GAAP and taxable income. You can read it here. The temporary differences, there is two kind. The first one, the differences about the recognized earlier in tax than in GAAP, and the second one is recognized later in tax than in GAAP. It grouped into two. It is about the revenues and expenses. And the next one, there are also permanent the differences, and there are 6 differences. Next, we'll talk about income tax analysis. The first one is financial statement adjustments. We note that deferred tax assets are not true assets in the sense that they do not account for any future benefits or impose any future obligations on the company. Because of this, many analysts exclude them from the balance sheet when conducting ratio analysis. The second one, present valuing deferred tax assets and liabilities. It represents potential future cash flow arising from reversal or of temporary differences. However, these reversals could arise many years later, in which case the present value of the cash flow effects will be much smaller than that recorded on the balance sheet. And the third one, forecasting future income and cash flows. Income tax disclosure are useful for forecasting future cash flows. We need to consider both permanent and temporary differences in our cash flow forecast. Analysts should examine a company's effective tax rates over the past few years to determine its permanent component. It is also useful to analyze the nature of the permanent differences so as to better estimate the permanent component of the effective tax rates. The fourth one is analyzing permanent and temporary differences. An analyst must evaluate why effective tax rates differ from statutory tax rates by examining the components that cause the divergence. And the last one, it is to analyze earnings management and earnings quality. The valuation allowance is a popular tool of earning management, so an analyst should therefore carefully examine any change, in particular a decrease in the valuation allowance, because it could be an attempt to manage earnings. In general, many analysts compare GAAP and taxable income to evaluate earnings quality. So that is about the analysis about income tax. So we reached the end of presentation about analyzing operating activities. We hope this presentation can help you to understand more about analyzing operating activities. Thank you for attention.